Welcome to Fear and Greed Business Interview. I'm Sean Aylmer. One of the biggest questions for investors as they head into 2025, in fact, at any point, is asset allocation. How much of your portfolio should be in local stocks? What about international stocks? What about bonds? What about cash? As always, this is general information only, and you should always seek independent advice before making investment decisions. Matthew Kidman is the principal at Centennial Asset Management, a regular here at Fear and Greed. Matthew, welcome back to the show.
Thanks, Sean. Thanks for having me.
People like me forget about asset allocation, but if you actually talk to sensible investors, they all say it's as important as stock picking.
I think that's right. I think you want a spread of assets, depending on your age and your situation, how much excess capital you've got to invest. But I think it's right because different asset classes deliver different returns. I'm one who's always been in the equity market, so I'm biased, but I would have thought you always hold a bit of cash. It can save you in a bad spot. I wouldn't be too geared into anything, maybe except your family home, which has obviously got tax benefits. And of course, you want constant income. So that can be delivered through fixed interest, or these days there's also private debt, which I think we can come to in a minute. But I think a balanced portfolio, but I think what we're doing here is what looks out for 2025 and where we tilt that balance so you get a better bang for your buck over the year.
Okay, so let's say we have an asset allocation. We have bonds, fixed income, so maybe credit in there. We have equities local, we have equities international, and we have alternatives, big, maybe that's infrastructure, maybe that's private equity, etc. So they're our buckets. Where do you think you have, and sorry, the other part to that is depending where you are in your lifestyle, how much in each you should be. But take that all as given. Where do you think you should be tilting heading into the next 12 months or so?
Yeah, that's exactly the right question. So where I would try and be is we're going into a higher growth phase because rates, even though in Australia they haven't come down, they have around the world, not as precipitously as what people maybe thought, but that's been supplemented by higher economic growth. So you've got this nice balance. So I think you still got to tilt towards growth assets, and obviously where you've had to be the last few years is in international equities, but fundamentally American, US equities, that tech end of town, NASDAQ, but even more broadly, the US has performed really well. As we know, the Fed's come off. It's done 3 interest rate cuts or about to do another one, and the growth situation is getting stronger. We think, let's see, new administration, but their promise is we're going to have a lot higher growth, tax cuts, less red tape. So I think you can still skew towards, I would buy general indexes, maybe an S&P 500 as opposed to the NASDAQ, which has been the big winner because I think they're going into a more cyclical strand of their rebound away from just structural growth. So maybe more of a broad index that captures that cyclical component. So I would tilt a bit higher depending on what you've got now. I'd tilt towards that. In terms of Aussie equities, been a lot more disappointing, and I think they'll continue to run behind the US, but I think it'll still be quite a good equity market. And as we said, we've talked a lot about in previous chats, Sean, what are the small caps doing? Because that's where I'm at. I think if we do get maybe 2 interest rate cuts during the year, that cyclical component will kick in, which is better for small caps. And so I think you can have a tilt at that. And I would tilt as the year goes on towards the cyclical component, probably an index. Once again, we haven't got a heavy tech component, so we can probably buy a broad index. I think with fixed interest, that'll be an interesting one because we've seen fixed interest around the world, obviously tested or led by government bonds and everyone else follows. And we thought it was coming down. And since we've had that first official interest rate cut in the US, yields have gone back up, which has surprised most players. But I think now it's going to hang around, the US 10-year bond, which sets most other valuations around the world, will sit that 4.3, maybe up to 4.8, and we can grow pretty quickly. So I wouldn't be too scared because I don't think you're going to get, a problem. As we know, bonds inverse price to yield. So what you want a decent yield, but you don't want your price to collapse because your valuation disappears. I think it's going to be a bit steadier this year. I think it will stay in those 4s. It's not going to come down. That's a bit of a worry in the sense that we would like them to come down, but I think it's going to stay there. Steady, probably market weight on that. Cash, I think you can go underweight a little bit this year. Now, in a few years' time, I will change my mind, especially if markets rally, because you don't want to be underweight cash them. But I think you could probably halve your normal cash position because we've got a couple of good years ahead of us. Property is an interesting one. I'm not quite sure. Depends. Property is a bit more nuanced, and there's a lot of divisions there. And I'd probably go underweight property. Commercial struggling since COVID. Residential, there's a lot of roadblocks in that. And industrial's just had such a boom market. So maybe a little bit underweight. And the other one we talked about, which a lot of financial planners and their clients have got into, it has been opened up, is private credit or private debt. And that's opened up 2 funds that have gone into that area because our major banks, it's happened all around the world, have moved out of this area, creating a void. And so you can invest in funds there. I don't think you want to be overweight there. That has been rushed, that market, and there's a lot of capital flying in. And I think over the next couple of years, if that continues, I'm not sure there's the asset or quality of assets to back those, that money going chasing it for the yield that you're getting. So you don't want assets going bad when you're lending that business money through a fund because you can't actually see the business because the fund's doing it. All you see is the fund, tells you it delivers 9, 10, 11% yield, looks really attractive, but you can't see what's behind it. So I would start to tilt away from that. It's been a good spot for everyone because there hasn't been any blow-ups. But as we know, debt can get you into trouble if you're on the wrong asset. So that's how I would see your portfolio this year.
A whirlwind tour of asset allocation. Matthew, thank you very much today.
Thank you, Sean.
That was Matthew Kidman from Centennial Asset Management. This is the Fear and Greed business interview. Remember to get your own independent advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.